We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Kevin Wadsworth from NorthstarBadCharts.com. Thanks for joining me today, Kev.
It was a pleasure to join you, Tom. How are you doing?
Excellent. And again, it seems like a theme that we repeat often here, but it's you and I were speaking before we hit record here and saying just that there's so much stuff to try and pay attention to right now, to try and, let's say, prioritize to figure out how that affects people, how that's going to affect the system going forward. But, you know, at the end of last week, you wrote a piece entitled "This Time, the Entire System is at Risk." And I wanted to get you on as soon as possible to talk about this a little bit. You started by saying that you don't want to make a habit of this, but even if there's a 10% chance risk of widespread systemic collapse in Europe, that you want to be on the record as warning about how you see the risks of this time going forward. So you also say that 10% because of your background in risk and emergency planning is too high to ignore. So maybe let's start with what you see as the risks that you're assessing.
Yeah, sure, Tom. Yeah, as you mentioned there, my background is in emergency planning and working with the military and so on, and assessing risk. So when I say 10%, it's and people have asked me, where do I get 10% from? And it's really from a lot of technical chart analysis over the last sort of 10, 15 years, and a gradual awareness and build-up of what's going on in the charts. So it's my personal assessment of where I feel the systemic risk lies at the moment. Now, a lot of people would probably, say that the risk is much higher than that of a systemic failure, and I wouldn't really argue with that. But even if the risk is only 10, 15%, something of that order, it's too high a risk for me to ignore. Mm-hmm. And I'll just share my screen and I'll go through why I think that is the case. So that post I put out and I made it public. It's on the website, of course, NorthstarBadCharts.com, and this is what I'm talking about. So I'll just go through a couple of slides here. And the first one I just want to draw your attention to is the U.S. government debt. Now, the red line there is parabolic. It's a parabola, and a parabola is just a line trending towards infinity, where as you move from the left-hand side to the right-hand side, the line gets steeper and steeper and steeper until it turns into a vertical line. Now, that is US government debt, not taking into account all the unfunded liabilities. So we're talking somewhere north of sort of 31 trillion, probably now 30.9 trillion, that kind of thing, which is fine. Okay. But as long as your country's GDP is rising at the same sort of rate to be able to sustain that kind of debt accumulation, then it's not too much of an issue. But as a mathematician, then of course I'm sort of focusing on when the math doesn't add up anymore, when the sums don't add up anymore. And you can see quite clearly that the debt to GDP ratio, those figures that I've highlighted there, have risen steadily from 40% or so past 60%, 100%, and now at 130%. Okay, so these are all numbers. What does it mean? Well, economists far more qualified than myself have a fairly good agreement that anywhere between about 60 and maybe 75 to 77% is as high as you can push this in terms of debt to GDP over an extended period of time, and for it to remain sustainable. If you stay above those levels for any length of time, it has a slowing effect on economic growth. That's what the economists say. It's not what I say. That's what the economists tell us. And so that's a first little indication that we may be getting into some kind of trouble here. Of course, you'll point me to Japan and say that Japan's debt to GDP has been much higher than that for much longer, and it hasn't caused them a problem. But you have to bear in mind that Japan is not the world's holder of the world's reserve currency. It's not in the same sense as systemically important as what's going on in the United States, and their debt is structured differently to the debt in much of the rest of the world. It's a lot of their debt is internal, which is very different, of course, to the situation of the United States and the US dollar denominated debt.
And of course, last week we saw we saw kind of a blowout of their currency as well. So they're in the process of trying to keep value in the yen while at the same time not having their yields blow out. So I think that's a developing situation, just as the UK as well, right?
It is. And I think what we're seeing at the moment is various cracks starting to appear in what I'll just call, in inverted commas, the system. And when I say the system, I mean our fiat monetary system that links the global central banking system and global trade. This is a chart that I've been showing for, I don't know, probably a couple of years now, maybe longer than a couple of years, since I started to become aware of the implications of it. It shows you that in the 1970s, we were in a different era, a different paradigm. In the 1960s and 70s, the 10-year yield in the United States was rising, and it was held up by a support line. And we had high yields, high inflation, and when inflation was at these sorts of levels, the interest rates were somewhere around 8-9%. I'm talking about in Europe here, where we've got sort of 9 or 10% inflation. Interest rates were up around 8-9%, and the higher levels of interest rates were able to eventually have a calming effect on inflation. So it's meant to work, of course, and with a very high interest rate, both in the United States and across here in Europe. Once we got sort of north of 15% or so, the yield fell very strongly. Of course, demand was seeping away at that stage, and so you've got a drop in demand as prices just become unsustainably high, and the whole cycle reverses, which is fine. That's okay. And then we had 40 years of a completely different paradigm, declining channel. And that declining channel was characterized by an upper resistance line. So the yields, instead of being pushed up and held up by a support line, were being pushed down and held down by a resistance line. That's how, from a technical charting point of view, you can identify these shifting paradigms. You know, people talk about them, but when you actually look at a technical chart, you can draw the roadmap, and the roadmap is useful because you know by drawing this roadmap that if the 10-year yield ever crosses that resistance line, we've got a massive change, and we've got a change of paradigm. And why is that important? Well, it's important because that resistance line is there for a reason. It's there because any higher than that resistance line is going to cause pain. That's telling us where the limit is of the 10-year yield and the ability to meet debt repayment obligations in relation to the debt, the level of debt, and the debt to GDP that I was just talking about. Mm-hmm. So given your current level of debt and debt to GDP, the comfortable point that you're allowed to go to is that resistance line. Well, we've pushed through it now. We're north of that resistance line. We're on the wrong side of it. And notice how the resistance line is slipping away with time as well, because the debt is increasing. So even if we move down and interest rates come back down to 2.5%, we'll still be on the wrong side of that line. We'll still be causing stress and problems in the system. And what we're seeing around the world now is the cracks appearing from the stress that's being caused. When I drew this chart a couple of years ago, I didn't know, I called it the pain line, because all I knew intuitively was that if the yield crossed that line, we'd see pain, what I would call pain. In other words, stress in economic institutions, be it banking institutions, be it problems with credit default swaps or the mortgage market or whatever it happens to be. I knew that there was going to be some major economic issue if the line ever crossed the resistance line, which it now, of course, has done.
And Kev, just go back to that chart for a second. Yeah. It really speaks to, you know, the way you worded it in the post is like the promise of being able to refinance debt 2, 3, 5, 10, 20 years down the road at the same or lower rate. And I think the other thing worth considering here is the speed at which we've broken that line and gone above it, right? So it takes the markets, the debt markets, all of these different markets a while to be able to digest moves like this, doesn't it?
It does. And I'm glad you sort of paused me there to sort of bring me back to that point, because again, I'm not an economist. I'm a forecaster. I'm a technical analyst, and I'm a statistician and all that kind of stuff. But I'm not an economist. But to my sort of scientific way of thinking, if you like, the problem that we've got is that in this era for 40 years now of ever declining yields and ever declining interest rates, is that the market has become accustomed to that, and not just become accustomed to it, but relies on it. I think we saw during the financial crises around 2007, 2008, and again in 2010, 11, when we had the sovereign debt issues over here in Europe. We saw that just how much the entire economic system relies on these incredibly low rates and incredibly low yields. And it's not just, as far as I understand it, some of these sort of complex financial products, they don't just rely on yields and rates being low now. They rely on the trust that and the belief that yields and rates will be low into the future, be it 2 years in the future, 5 years in the future, or 30 years in the future. And the very thought or suggestion or lack of belief that that is the case is likely to start causing some major issues. And I think that's where Credit Suisse and Deutsche Bank and the issues around what's going on with those institutions and other highly leveraged banks around the world, and the derivatives market equates to some ridiculous figure that is in the multiple trillions or tens of trillions. I mean, it's a number that I can't even comprehend. But suffice to say that if the cracks get big enough in that market, it probably is enough to bring down the financial system as we know it. So that cannot be allowed to happen. And if the unthinkable happens, then I don't quite know where that would end unless we start talking about central bank digital currencies, CBDCs, which are that's a whole other topic. So perhaps this whole thing is being.
we'll get to that, and I want to get your thoughts on that. But I think it just goes back to the idea that seeing this basically this breakout and seeing the downstream effects of what raising rates like this has caused. It's interesting. I saw the headline again this morning that the UN has asked the US Fed, to stop raising rates. And I don't think the US has raised, or it would be very few times in history that the US has raised rates this aggressively, this quickly, right?
I think I saw something on social media where somebody had put up a graph of the rate hiking cycles, and unless I'm mistaken, this current rate hiking cycle is more rapid than any of its predecessors. Maybe that just shows how far behind the curve the Fed are, level of panic or whatever. But the point really now is that we're starting to reach something of a breaking point. Just looking at the historical context, and again, this is another chart that I've been showing for quite a long time now. Since before the issues that we've just seen more recently, in terms of the stress in the system. But this chart made it very, very clear to me that we were in historic times. When you got a country like Germany, which is systemically important, the ECB and the European Union rely on Germany being a successful and fiscally prudent country with plenty of finances to throw around the EU to help fund all the shenanigans that go on in the European Union. But when you see the producer price index in a country like Germany going not just past the peak of the 1970s, but past the peak of the post-war chaos that was disaster that was left post World War II, we are now in completely historically uncharted waters. So when people say to me, Kevin, you're talking about what makes you think that something's going to happen that's going to be looked back on, 50 years from now as truly historic. Well, I'll point them to this chart. If you've got historic charts like that are setting new precedent, would it not be a bit foolish to think that we're not going to have historic levels of outcomes from this? There's a delay between producer price index rises and consumer prices and inflation and all of the knock-on effects. But to have producer prices spike to a high level for a short period of time is one thing, but this has been month after month after month after month all the way through this year, last year, We've been at these levels, higher than the 1970s. So, when I was listening to the Fed sort of saying, this is transitory, I was kind of in utter disbelief, shock, and horror, because they were either not looking at the same charts as me, or they're looking at the same charts as me and just completely ignoring them, or deliberately misleading us. You take your pick from from that selection, but I'm sure they must look at the same data that we do. It just staggers me, some of the stuff that they come out with, and Janet Yellen and all the rest of these talking heads just seem to talk utter. I can't say the word because this is going out in a broadcast, but it's ridiculous. And also looking at, it's not just Germany, of course. We've got the chart here for the Italian producer price index. It's taking off like a rocket ship. We've got here the French producer price index. That is taking off like a rocket ship going vertical. This is the European Union, the EU, Eurozone as a whole producer price index. This is the composite of all of them. And after a very short and very small little pullback a couple of months ago, it's re-accelerating out into the stratosphere again. So you can see, that very long base, that very long period where producer price index historically oscillates up and down as the cycles play out. But we've broken out. This is a technical breakout that's going to goodness knows where, and goodness knows what the consequences of this are going to be. Just looking at currencies, and this gave me pause for thought. This is the British pound versus the US dollar, and we've had absolute chaos here over the last couple of weeks as our new prime minister decided that she was going to reduce the higher rate of income tax, and suddenly the markets had a complete panic because it was seen as highly inflationary. And the pound versus the US dollar tanked. It was headlines all over the place. And at that exact moment, when a financial news item makes the headlines on the mainstream news, you can pretty much nail that point as being the bottom or the top, depending on what the news story is. It's either been going up and nobody's noticed, and then you get the news story and it spikes and hits the top, or the reverse happens. That's exactly what happened here. I put the chart out and I said, right, that's it. That's probably the bottom. And no doubt a lot of people will be sort of laughing at that. And fair enough. The UK pound could crumble and end up, sort of going to, 10 cents or something. But it's not what the evidence is telling us. The evidence is telling us that the problems now are going to shift across the other side of the Atlantic, and something or other is going to start causing issues in the United States because the British pound has hit its bottom. But this is just a reminder that when you get these headlines, put your contrarian head on and start, realizing that these are exactly the headlines that you need to mark the bottom. And the same goes for precious metals, gold and silver and all that kind of stuff. Whenever any market, whenever it makes mainstream news headlines, look for it to reverse pretty pronto.
Well, and just going back to that, Kev, it's interesting that it has forced basically the UK to go back into quantitative easing, right? Which is typically very, let's say, bullish, yet the people that understand what happens to your purchasing power in a situation like that is bearish, right?
Yeah, there's a curious thing with quantitative easing and interest rates and stock markets, and people tend to have little rules in their head that sort of suggest that when X happens, Y happens. Mm-hmm. But that's not true, because you need to have the context. So X happens causing Y to happen, but only in certain circumstances. If you flip those circumstances upside down and you're in a different paradigm, then you get a different result. So quantitative easing at certain points in time and the pivot. I'm trying to sort of get round to segue this into the Fed pivot. Mm-hmm. The Fed pivot, when it comes, which it pretty much assuredly will at some point, the Fed pivot. A lot of people are in their mind thinking, right, the Fed pivot is going to cause the S&P to to go to the moon, or it's going to cause the S&P to break out and melt up and all that kind of stuff. That's not what history shows. History shows that if the S&P is below its 3-year moving average, and you can check this yourself. I've done a post on it on Twitter. Go to my North Star Twitter page. You'll see a nice illustration of this. When the pivot happens, when the S&P is below its 3-year moving average, do not be expecting a melt up, because it ain't going to happen. The precise opposite happens, because the markets perceive it in a different way. When there's a problem, when there's an issue, and when the markets are tanking, it's sending a different message. It's sending a message of, there's something going on here. They've pivoted for the wrong reason. They're reducing rates for the wrong reason. So you can either reduce rates for the right reasons or for the wrong reasons. So it's all about context. Mm-hmm. Just to illustrate how crazy things are at the moment, I mean, UK electricity prices, I could have picked any European country. Electricity prices or natural gas prices, we heat our homes over here using a combination of electricity and natural gas, and natural gas is actually used to power the power stations that give us the electricity. So we've got a bit of a problem there. If we've got a problem with natural gas, we're going to have a problem with electricity, and the whole thing's feeding into itself. But look at those numbers on there. We would expect prices to be historically anywhere around 40 or 50 pounds per unit. We're up at I was going to say 5 times, more at 10 times historic norms. So we're seeing prices move, and this is natural. This is the electricity prices in the UK. This is wholesale electricity prices that the energy providers need to lock in to then pass on to the customers over a fixed period of time, whether it's 6 months or 12 months. This is the wholesale market. So they're buying electricity on the futures that are at multiples of where they're historically expected to be, or where they have been in the past. So this isn't some kind of meme stock or cryptocurrency that's gone up by 1,000%. This is UK wholesale electricity prices, and I could show you the natural gas chart, and it's exactly the same as well. So we've had a price cap over here. They've capped the price per unit for the customer, not the absolute price, but the price per unit. So the average customer will now be paying around about double what they did a year ago. So the price to the average customer is 100% rise. The difference, the rest, is being borrowed, paid for by the government. And guess what the genius plan is? The genius plan is that when times get better, those costs are paid back by the consumer. So even when the prices come down, they're not going to come down because we've got to pay it back. So if that's not locked in inflation, I don't know what is, because you have to remember that this electricity, and this applies to industry as well. I'm not just talking about Mr. and Mrs. Smith in their house. I'm talking about industry producing everything that we need, from cars to engines to tin cans to all the stuff that we need in our homes. They're using this electricity at these prices. So that is locked in future inflation. We're kind of guaranteeing that we're not going to see prices coming back down to anywhere near the levels where they were 12 or 18 months ago in terms of consumer products, in terms of the CPI. So we're kind of trying to kick the can down the road a little bit more, but then we get headlines like this: UK at significant risk of gas shortages this winter, and these headlines are repeated right the way across Europe. Mm-hmm. Credit Suisse, credit default swaps hit record high as shares tumble. We've got Putin threatening nuclear threats in Ukraine. We've got Germany suspecting sabotage of the Nord Stream pipelines. Goodness knows who did that, and there's so many theories out there. But when you have state actors blowing up international energy infrastructure, and the site of the destruction was not in a war zone. It was not in Ukraine. The Nord Stream pipeline doesn't go through Ukraine. It goes under the ocean between Germany and Russia there. So what's happening in the world at the moment is dangerous, very, very dangerous. And what's happening in the markets is very, very dangerous. So we're at an incredibly risky point in time that is probably quite comparable to the 1930s in many ways, in fact, in terms of the economics and in terms of the politics.
Mm-hmm. Going back to that idea about the the shortages of gas in the UK. I spoke with Doomberg last week, and he pointed out that the UK only has the ability to store something like 1% of what they need for a month or something like that.
It's ridiculous.
Their storage capacity is negligible at best. So to say that they can rely on their stores is not an accurate statement either, right?
No, well, I spent many years working in contingency planning with the emergency services and with the utilities companies. So my ex-colleagues are currently, and to be fair, we spent many years practicing something called Black Start, and Black Start is an exercise which is effectively simulating how the UK would cope if power was off for a week, couple of weeks, something like that. Mm-hmm. But of course, we're talking now about a threat that goes on not just a week or two, but for month after month. And so contingency. People need to be prepared for the power to go off. I'm telling my friends and family, just imagine what it would be like if the temperature outside in the winter is 30 degrees Fahrenheit, 0 degrees Celsius, 32. Blooming freezing cold outside. You've got no power, you've got no heating, you've got no utilities at all. What would you need? Just think in terms of effectively having a 6-month camping trip and get what you would need: the food, the water purification, the ability to charge your mobile devices, so you can buy these wind-up radio torches that kind of do that for you. All that kind of stuff. The ability to cook. Canisters. I'm not a prepper, and I never thought I would say this, but when government departments are seriously planning for long-term, large-scale energy cuts, then people need to be prepared for that, because when it happens, there'll be a panic, and you just won't be able to get the stuff that you need. And so, without trying to scare people, and that's the last thing I want to do, just take reasonable precautions. And this probably applies it does apply across the whole of the European Union, and quite possibly in time in the United States as well. So, we cannot rely on a lot of things that we thought we could rely on anymore, and people are very slow to kind of get that into their minds. But as I say, spending 12 years in emergency planning there is kind of part of my DNA.
Mm-hmm. Yeah, and I think another piece of that is that when natural gas gets this expensive, it's not economical to produce fertilizer out of it, which affects crop yields, which affects ability to produce the food that, as you say, people have relied upon for so long. So it's really such a multifaceted problem that we're constantly facing here.
It is. This is where you start to talk about dominoes, and it's a term used to describe that, when something happens to one element, it has a knock-on effect with another element, and then a knock-on effect on another and another. And I'm afraid energy is involved in everything. And he who controls the energy controls the world effectively. So without energy, we are, going back to cavemen, basically. So, it is that serious. So, the European Union and the rest of the world needs to get moving fast in terms of becoming energy independent. Luckily, the UK is quite energy independent. We have a lot of wind and tidal power and nuclear energy, which means that we don't rely too much on fossil fuels and gas and that kind of thing. But we still have gas-fired power stations. Gas price still does affect our electricity generation to a significant degree. But there are countries that are a lot worse off than the United Kingdom. It's windy here in the winter, so we've got a lot of wind turbines in the oceans around the UK. So we're probably better positioned than many. In terms of stock markets, and this is for investors the important bit really. So if you're thinking about investing, be it in general equities or in commodities and precious metals, this is the bit that you want to focus on. The S&P. Sorry, this is the NASDAQ chart I'm showing you just here. The NASDAQ has broken down. I'm just glancing across to my screen there. The NASDAQ has broken down below its 3-year moving average. The quarterly close was below key support. And history tells us that it wouldn't be unreasonable to expect a drop of 70 to 80% from the peak. If that were to become increasingly clear that is happening, you would probably get increasing concern and panic amongst investors, because all they've got to do is look back at the other 3 times that this happened since World War One, and notice that on each of those 3 occasions, it has taken more than a decade to get back to where you started from. And in fact, sort of 15 to 20 years is just about normal. So what does that capital do? Well, it's not going to hang around for 15 or 20 years in general equities and the stock markets. I can tell you that for nothing. It is going to find the markets that do well when general equities and stock markets do badly. And we're talking about hard assets. We're talking about where the investments go during bad times. During bad times, people revert back to precious metals, gold, silver, platinum, palladium, energy, uranium, all of these kind of things that we need rather than things that we don't need. So tech stocks, we don't need those. We can live perfectly happily without tech stocks. But without being able to feed and clothe and keep yourself warm, you can't, you need that. So the miners who are pulling this stuff out of the ground, that making the stuff that we need to live and produce our energy, that's where the money flows. And you can spot that on the ratio charts as well. This is the S&P 500. S&P 500 closed the last month of September. It was a quarterly close, and it closed below the 3-year moving average. Quarterly closes below the 3-year moving average are not what you want to see. And when that happens, you get the sort of pullbacks that I've indicated on the chart here. So again, it would not be unreasonable to expect a very large drop. And that red line, that is critical. I don't know what kind of a situation and scenario we're getting into here. Clearly, if global conflict escalates, then that red line isn't going to contain the stock markets. If either China and Taiwan or Russia, Ukraine, or any other black swan event along those lines occurs, particularly if either tactical nuclear weapons, chemical weapons, or something worse were used, then that red line is going to break, and it's going to do what technical charts usually do when support lines break, and you can expect. I don't really want to discuss what would happen there, because if that red line breaks, it means that we're in a world that I'm not too sure I want to be living in, to be honest. And I just want to get this across to people: do not have bias. Do not rely on what Joe Schmo on YouTube is saying. Bitcoining to the moon, or gold to the moon, or silver to the moon, or whatever. Just use the technical charts to eliminate that bias, and this is exactly what this chart does. Gold and silver are not going to be in a confirmed bull market until gold versus SPX breaks out. And you can see the last time gold versus SPX broke out, just after the 2000 lows in gold. It's around about 2002, and that confirmed the move. This chart got above the breakout line. It got above its 3-year moving average, and off it went. Those are the technical indicators we're looking for. Now we're getting very close to breaking out. We're getting very close to the 3-year moving average. I actually haven't looked at it today. It's probably even closer by now. It might be up at a sort of 0.47 or 0.48, but 0.49, 0.49, as we'd say here in the UK, is the level now that we want to see the ratio break out. So the gold to SPX ratio, if that breaks out and we get a monthly breakout, then you've got the all clear from me to fully expect a long-term precious metals bull run. Same with this chart. This is gold versus NDX. I'm just glancing over the screen on my left here. And this is gold versus NASDAQ ratio. And this is important because it's broken out. So gold versus NASDAQ has now broken out. And I think the silver chart has as well. I think I might have posted one on Twitter in relation to silver. So silver has had a big move. I think it moved about 8% in a day. And gold versus NASDAQ has broken out. So is this the very first early sign that we truly are in that new paradigm that I was talking about in terms of the precious metals? And we're going to find that out this quarter, I think. So October, November, December, we'll get the quarterly close in December. But if we get a monthly close and a monthly breakout for gold versus SPX, then that's my green light. Myself and Patrick following a number of evidence charts, the gold to silver ratio, gold to money supply ratio, the 30-year yield divided by the 10-year yield. These are all key charts that will confirm beyond any reasonable doubt that we are in a long-term precious metals bull era and commodities bull era. And we're right on the cusp of that at the moment.
Yeah, again, the phrase that Patrick often uses is adding to the weight of evidence, and having this many charts confirm that really seems to, give you confidence that that's where we're headed. But, one of the lines in your post is that despite your guys' belief that you're heading towards a secular commodities and precious metals bull market, it might be difficult might be a generous term to measure those goods against commodities. So why is that? Or sorry, against currencies.
Oh, right. Okay. Well, effectively they're adding zeros to currencies. So if you're comparing anything to a paper currency, then you're probably not really measuring it against what you need to be measuring it against, and that really is gold. Your purchasing power has been declining ever since the US dollar came into existence, and it's declined by about 99% by now. If you, as an investor, you want to be invested in the vehicle that is giving you the best returns. So whatever you're investing in, you need to pull up a ratio chart of that versus inflation. So PPI. On TradingView, you can type in PPI ACO. That's the producer price index for all commodities, and whatever it is you're wanting to invest in. So if it's platinum, you do platinum divided by PPI ACO, pulls up the ratio chart, and you can see straight away if that particular instrument is outperforming inflation. If it's outperforming inflation, good. Also check to see if it's outperforming SPX. So if you're outperforming the S&P at this point in time, which most things probably are by now, and also outperforming inflation, then you're staying ahead of the game. Worst thing you can do is stay in cash when inflation rates are at 10%. That's the official inflation rate over here. Or put it into something that's actually not outperforming the PPI.
Yeah, it's such a difficult thing to think about because, in some ways cash has been, or let's say US dollars this year have been a reasonable place to park cash.
But there are better places. So, if you compare, the uranium miners, for example, is a good example because they're in a trending bull market now. So, compare uranium over the last couple of years to the US dollar and to inflation, and you'll very quickly see that if you'd spotted the breakout in uranium versus inflation and uranium versus the S&P, you would have been far better putting your cash to work in the uranium miners than just leaving it sitting in cash when the inflation rate was 4-5%. So, and that's quoting official inflation figures. I'm sure it's probably more like double that. So be careful where you put your hard-earned cash, fiat currency, and just make sure that it is outperforming inflation. So have that PPI chart ready and just divide your investment choice by PPI. And if it's not outperforming inflation, look elsewhere. And as I say, precious metals over time, gold is a good sort of hedge against inflation. There are periods when it does badly, there are periods when it does well, but over an extended period of time, it's as good a place as any for many reasons, to park some of your, not suggesting put all of your money into physical gold, but, to have a portion allocated to precious metals makes a lot of sense, particularly in times like this, and particularly after we've just had a long correction. We've had more than 2 year drawdown from $2,000 to $1,600, which actually, given the strength of the US dollar, I think most people probably agree, is quite good performance. The US dollar has shot up from 72 to 115, and in the same time period, gold has gone from around about $1,000 to $1,600. So over an extended period of time, the dollar index has gone up a huge amount, but gold has gone up.
Mm-hmm.
So that goes against a lot of what a lot of people expect.
Mm-hmm. So Kevin, when we're talking about, let's say, riding this storm out in precious metals, do cryptos to you provide a possible path through this as well?
Yeah, they could do. Bitcoin, Ethereum, Litecoin, looking at the crypto total market cap is probably the chart to focus on. Crypto total market cap follows all of the money invested in crypto space. I think it's currently sitting at about 850 billion or 880 billion, that kind of level. And it's sitting on a support level pretty much at the moment. When it's the same as any other chart, no bias, no preconceptions. When that chart breaks to the upside, gets above its 30-week moving average, gets above its weekly declining resistance line, then you have the evidence. And if it can do that, it's telling us that it's decoupling from the stock market based on the assumption that the stock market continues to struggle. If Bitcoin can reverse its relationship with the NASDAQ, because you have to remember that Bitcoin has never existed in these financial situations. Bitcoin has never had to exist through a cyclical economic downturn and the S&P being below its closing below its 3-year moving average as it's doing at the moment. So this is a real test for cryptocurrencies, and I have some hope that they will prove their worth. They may not. What I think doesn't matter, and what anybody else thinks really doesn't matter. It's what the chart tells us that matters. So if Bitcoin, Ethereum, and the rest, and the crypto total market cap can actually prove to me, they've got to prove it. They've got to get above the 30-week moving average, the 200-day moving average. They've got to get above the declining resistance line. If they can do that, then I'm going to start taking positions again, and I'll recommend to others that they might want to start doing the same. But I'm not going to encourage people to try and jump in at the bottom at the moment, because you get no evidence at the bottom. You don't when price is coming down, a bit like this chart behind my shoulder here. Mm-hmm. When price is there, there's no evidence it's going to stop, and then it starts going up, and it crosses that line there. That's why you start getting the evidence. These little stars that you can see on here are our star system that we use on the website, and we award these stars for different pieces of evidence that we get on the technical chart. Mm-hmm. And until you get that 5th star, you don't have a strong evidence case. When you get that 5th star, boom, off it goes. So catching that part of the move, that bit there, mm-hmm. is what's the clever bit to do. Trying to catch that bit at the bottom there is the foolish thing. There's no evidence. It could have just carried on down to Henrik Zerberg's $800 or whatever it was he was saying that gold was going to go to. So, it's all a case of using scientific evidence and following the chart and trying not to have any bias. If you can eliminate your bias, then you're halfway there.
Well, that's actually something I wanted to touch on with you. If we do see a break of the system here, Kevin, is it possible that we see some huge wicks in the metals? Meaning, do you think the possibility of gold and silver paper prices getting sold off dramatically along with the rest of the market?
Certainly, yeah. That is certainly a risk at the moment, which is why we're holding our nerve and not entering new positions right at the moment, because the systemic risk is high, liquidity-driven sell-off, ending up with a huge wick to the downside, like we saw during the COVID panic in March of 2020, those mm-hmm. wicks that went down and then suddenly reversed, and by the time the month closed, you're way back up again. So that kind of event, or even something worse, is certainly possible. Until we get above those breakout levels, then that can happen, which is why we're holding our horses. And if you also use risk and money management very carefully, you don't need to have fear of missing out, because you can enter at a higher price point and your risk to reward is the same, because you can set your stop loss more tightly. You have a higher swing low, so you have a tighter stop loss, so you can still achieve, a 20-to-1 risk to reward ratio and see your NAV increase by exactly the same amount as if you try and pick the bottom there. And if you get it wrong, then you end up having a whole load of opportunity costs, because you have to wait goodness knows how long to get back to the breakout point. So waiting for the evidence is the wise thing to do. Trying to catch the bottom, maybe, I don't know, maybe use 5% of your, or risk 5% of your NAV trying to catch a few falling knives. But I would not, it's not something I would particularly recommend. I always prefer to wait for the evidence to come to me. People say wait for the market to come to you, and there's a lot in that. So that's a good way of sort of saying wait for the evidence. Wait until you know for sure, and then you can take your positions. Then you can make the same kind of gains because you have those tighter stop losses, so you can have the same risk to reward as if if you're getting in lower down. So it's lower risk, same reward. What's to lose? There's no need to feel that you have to panic now and gold's bottom, silver's bottom, I need to dive in. And then we get some kind of event happening in a couple of weeks' time, and you end up with $14 silver and $1,400 gold, and taking weeks or months or whatever to get back. So just stay calm, use the evidence. That would be my advice.
Well, and to that point, we saw silver up almost 9% yesterday. So how do big dramatic moves like that play into the charts? And do we need, a confirmation of closing at those levels to sustain a move like that?
Yeah, this is it's easy to get carried away with this kind of move, isn't it? I mean, I was looking at my portfolio yesterday, and there were a couple in there that went up by 50%. That's great. It's gone up 50%, but actually it's gone up from 0.01 to 0.015.
Yeah.
So it's gone up like that much. It's full. So it. I mean, these big moves on small time frames don't mean anything really. They can be exciting. They can be encouraging. They can be the start of a long trending move, and it may well be that. But silver still has not got above any of its key breakout levels. It's not got above those really important moving averages. It's not got above its breakout line, which is, I don't know, somewhere around $24, $25. I'll have to have a close look at the chart, but it's a good few dollars higher than where we are at the moment. So I'll be posting on Twitter, and for our members with more detail, with stock recommendations, all that kind of stuff when it happens. But I will put stuff on Twitter to let people know when the general markets are crossing those thresholds and crossing those levels. And until they do, it's great, it's exciting, but it hasn't proven anything. There's no weight of evidence that's been added yet. The weight of evidence comes when you cross those key thresholds, and they're always the same. It's the 30-week, the 200-day moving average. If you read Stan Weinstein, the 30-week moving average is very, very important. The 12-month moving average, the 3-year moving average, and those weekly defined breakout lines, and things like the Ichimoku cloud. Those people who are a bit more into their technical analysis and are familiar with the Ichimoku cloud, and looking at the stock RSI and those kind of things. There's a whole sort of raft of other technical indicators that you can look at, and once they all start telling you the same story, that's when you can have the confidence. Because sometimes you get one thing that's telling you, oh, right, yeah, it's going to be, looks like we're going up. And then you look at another piece of evidence and it's like, oh, not quite so convincing. So you sometimes have an incomplete picture of evidence. But when all that evidence sort of coalesces and comes together, that's when you can have the higher confidence levels. As a trader or investor, you're far better placing a trade or starting an investment, a longer term investment, when you've got that strong evidence. And once you've got that strong evidence, you can take a larger position size. You might want to take a 2% NAV risk on a particular trade rather than 0.25%, for example. So,
Kev, you and I touched on central bank digital currencies earlier, and I've seen more and more chatter from governments around the world talking about digital currency, saying little things like they will be anonymous and easy to use. So, how do you assess the risk of those currencies?
The risk, if we actually end up with them, or the risk of getting them in the first place? I think they're coming. I mean, I'd be amazed if all of this isn't leading in that general direction, because there are multiple reasons why central governments, central banks would like to be able to monitor every single transaction that takes place, from a criminal point of view, from a control point of view, from a surveillance point of view.
Tax point of view.
Tax, exactly. Yeah, no, there's no escaping if there's no alternative. And and which is where cryptocurrencies and digitized gold and silver come in, of course, because there are companies out there that are tokenizing gold and silver as well. So there were, I would like to think there are always alternatives, but the risks from central bank digital currencies are, no different to probably any other monetary regime. That it's greed and it's misused and abused, and at some point 50 years after they're introduced, the whole thing comes crashing down for the same reasons that the paper currency system has come crashing down. It's not the people who are trying to avoid paying a little bit of tax that are causing the fiat currency regime to break at the seams. It's not that. It's the central banks themselves who are recklessly printing to infinity to resolve issues that they themselves have created. So, and when I say that, they themselves have created by not having it backed by anything solid at all. It's just a promise to pay the bearer on demand, or whatever it says on your banknote. It's a trust thing. When trust is lost, the currency is lost. And the moment that Bretton Woods was abandoned and the link to gold was abandoned, then you can identify that point on all the charts, because from that point on all the charts, it looks a bit like this one behind me. It just goes up, and everything sort of trends up towards the top right hand corner. So that's why we're in this mess.
Like that S&P chart that you showed earlier from early 70s, it just goes up like a checkmark almost.
Exactly, and eventually. Anything that's going up at a parabolic rate, as any scientist or physicist will tell you, nothing can go up parabolically but forever. The system collapses, it breaks, it crumbles, and it just literally falls apart. And that's what we're starting to see in front of us. And there are going to be a whole load of different attempts, different clever techniques to try and extend the inevitable. And I'm quite sure that all of the conflict in the world at the moment is highly correlated and related to that, and just how coordinated all of this is. We will probably never know, but there are a lot of coincidences and a lot of things going on at the moment that just don't kind of add up. And you don't need to be much of a conspiracy theorist to realize that. You just need to have your eyes open. No doubt some of the stuff that is dreamt up on social media is complete garbage and is a complete conspiracy theory, but there are a lot of unanswered questions about a lot of stuff that's gone on over recent years, and stuff doesn't add up. And it's probably not surprising, because trying to control a train wreck like this, there's going to be a lot going on in the background that central governments not central governments, but those who are have their hands on the levers of power, true power, are not wanting the rest of us to find out about. So it's probably best we don't know about it as well. All we can do is try and protect ourselves as best we can.
I was actually thinking about that yesterday, about the spread of information when something very important and, let's say, systemic or extremely risky happens, how that propagates through the world and how it's managed at the highest levels. It's kind of scary to think about, to be able to base your actions on news events like that, because if something extreme does happen, it makes you think if and or when you'll be notified that has happened, right?
Yeah, and no doubt some of these events are distraction techniques anyway, and it's not surprising that the crowd rushes in one direction whilst those in the know are rushing in the opposite direction. It's like a stampede of sheep all heading in one direction, where really they should be going the other way. So and the information spread is instantaneous, and those that are wishing to control the actions of the masses are completely aware of that. I'm absolutely sure. So if you want to distract, it's very easy to do that, and false flags left, right, and centre. It's impossible to know what the truth is these days, and that is a problem in itself. When you have a society who is very untrusting of those who are governing, that's a recipe for social unrest and civil war and outbreaks of violence, and lack of trust is a big issue in the world these days.
Absolutely. Well, Kev, on that depressing note, I think that's a reasonable place to wrap up for today. Of course, your guys' website, northstarbadcharts.com, you and Patrick Grimm, and your Twitter handle is at northstarcharts, right?
It is, yeah. And anybody that finds anything that I've said vaguely interesting, please do come along to my Twitter page and have a look and see if we can find anything else interesting there.
Mm-hmm. Excellent. Kev, thanks so much for your time today.
Okay, thank you very much, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.